The market didn't collapse today. It hesitated. You could feel it in the way prices moved small steps forward, then immediately looking over their shoulder. Investors weren't reacting to earnings or economic data. Their attention was elsewhere, drifting toward a narrow stretch of water that carries an enormous amount of the world's energy. When markets fixate on geography, it usually means the financial narrative has moved beyond balance sheets. Capital begins to price in uncertainty rather than information, and that kind of uncertainty rarely shows itself all at once. It arrives quietly, through hesitation. Oil pushed through 87, and what mattered wasn't the number itself, it was the market's refusal to believe supply would normalize quickly. Even after emergency reserves were authorized for release, traders kept bidding crude higher. That tells you something important. When markets ignore a supply response, it means participants are no longer trading the present. They're trading the risk of what might come next. Energy markets have always been about perception as much as production. And right now, perception is leaning toward scarcity. Normally, softer inflation data would have lifted equities. Today it didn't. The reaction was muted, almost indifferent. That tells you the market's hierarchy of concerns has shifted. When geopolitical risk enters the picture, economic data temporarily loses its ability to steer sentiment. Investors begin thinking less about the next policy meeting and more about supply chains, shipping routes, and energy volatility. In other words, macro risk starts to dominate the conversation. While equities debated geopolitics, something quieter was happening in credit. Large banks began reassessing the value of loan portfolios used as collateral by private credit funds. When lenders tighten collateral assumptions, it rarely appears dramatic on the surface. But inside the financial system, it changes behavior quickly. Borrowers become cautious, funds reduce leverage, liquidity begins to move more slowly. Credit markets don't shout, they whisper, and those whispers often arrive long before stress appears in public markets. Political leaders attempted to calm markets today, suggesting the conflict could end quickly. But reassurance rarely works the way policymakers hope. Markets don't trade on promises, they trade on probabilities. When a situation is fluid, investors assume multiple outcomes simultaneously. Some capital positions for resolution. Other capital prepares for escalation. The result is what we saw today, not a sell-off, but a market unable to fully commit to either direction. In the end, today's market wasn't about direction. It was about positioning. Investors are trying to understand where the exit might be if energy risk lingers and credit conditions tighten at the same time. That's a difficult equation, because markets can tolerate geopolitical tension. They can also tolerate tighter credit. But when both begin to interact, investors start scanning the horizon for stability. And until they find it, hesitation becomes the dominant trade.